Right now, let's welcome my first guest, Alex Vicencio. He's the Managing Director of Investments and a private wealth financial advisor at Vicencio Wealth Management Group of Wells Fargo Advisors. Alex, thank you for joining us today.
Thank you for having me.
It's great that you're here. I love talking to people from Wells Fargo. I know you've been in the business a long time. I've got a few questions for you in reference to our topics today in the show. My first question would be for you, Alex. What are some of the most common psychological roadblocks that prevent people from starting their retirement plan, and how can one overcome them?
Sure. Great first question. What we find mostly is that folks have some psychological barriers when it comes to being able to get their investment planning started. The first one that I think comes up very often is, am I too late? If I haven't done anything over the last few years, how do I really start doing that now? And am I still on time to do that? The other one is, can I really afford it? Do I need to, I don't have a lot of additional disposable income. And do I really have enough to really make a dent into a solid investment plan into the future? Meaning, I don't have enough to contribute, so maybe I just, don't contribute at all. So I think between those two of having enough time and do I have enough to start are two that we see pretty often.
So I guess you could say that there's a little bit of a misunderstanding and people put off retirement planning, that the earlier they start, the better, and there is a cost of waiting over time. So let's get into this next topic, Alex. What are some of the most potential pitfalls or dangers one can run into with a do-it-yourself retirement plan? Meaning, folks should really consult with a professional. So there's lots of do-it-yourselfers out there. What are the potential pitfalls and dangers for folks that don't have the adequate professional advice?
Sure. So I think that for proper investment planning, one of the things that we run into when we see some folks doing it on their own would be, for example, unrealistic investment return expectations. We tend to be very susceptible towards, what's in the news and what are reasonable.
Fear of missing out, right, is a big issue with consumers. So what are reasonable expectations for returns today? Where should pre-retirees and retirees be? What kind of return should they be expecting, do you think?
Right. So depends on each client, obviously based on their tolerance for risk, based on their time horizon, based on how aggressive or lack thereof they want to be. Think of it this way: a 10-year government bond at this point is paying, less than 2%. So anywhere between having all of your money in bonds and having all of your money in stocks, there's a pretty wide aperture for being able to look at returns. But certainly returns at this point are much more muted than I would say they have been in the past in terms of expectations.
I would agree with that, Alex. Well, right now we're sitting here with Alex Vicencio. Don't go away. We'll be back with more right after this break. Now let's welcome back Alex Vicencio. He's the Managing Director of Investments and a private wealth financial advisor at Vicencio Wealth Management Group of Wells Fargo Advisors. Alex, thank you for sticking around. We've got some more questions for you in reference to the topics of our show and investment planning and how that affects your retirement. Alex, the market is at all-time peaks. We see the market very high. Warren Buffett has the most amount of money in cash that he's ever had before, sitting on the sidelines. And the ultimate Buffett indicator is, as a percentage of market cap to GDP, we're at the second highest level since January of 2000. So in his mind, the market's overvalued. How are you advising your clients today to maybe protect themselves if they have portfolios of less than 1.5 million in value? What should clients be doing today in that age range and that price range on a retiree and pre-retiree basis?
Sure. That's a great question. We get asked that all the time, every day. And I think it really depends on, again, back to each individual situation. we are big advocates of, as you've heard this term, not timing the market, but rather time in the market. So as that would explain, we like the idea of having portfolios that are properly allocated based on each individual's overall investment plan and aspirations. And if possible, which I know it's very difficult, ignore some of the outside noise and maintain a diversified portfolio that during good times, say, for example, 2019, that's a good example of that, is able to do well. And maybe during bad times, as markets contract, you have some cushion for the downside. So I like that approach better. Again, using a mixture of different assets for balancing purposes.
So you're referring to really a diversification of bonds and maybe market-based stocks, domestic, global, all across the board. Is that what you're... And some cash too, sure. Well, of course, risk propensities vary based on one's particular client's needs, objectives, goals, and time horizons, of course. We know all of that. But it doesn't change the fact that the market's at an all-time high and that credit is maximum. You know, the Fed is still doing quantitative easing. They're buying short-term treasuries to keep the yield curve steepening. We had some great economic data. The consumer is very strong in our country. The economy is strong. We've got coronavirus issues, geopolitical issues. So an average retiree today, for an average retiree with a portfolio of, let's say, $500,000, which is about the average for our dynamic of our show, which pipelines into millions of homes nationwide, what do you think they should have as far as market exposure in your infinite wisdom? I mean, you're a CFA. You're very smart. Why don't you tell us what you think there?
I think that for a solid strategy that works, I think having a good amount of cash on hand, I think it's paramount. I think that allows people to weather the ups and downs of those markets. And by that, I mean, if you run into a year when you have a downdraft, whether it's the equity or the fixed income or even the real estate markets, it allows folks to be able to still maintain their cash flow and their standard of living by drawing on cash. And when I say an ample cash reserve, that could be two, maybe 3 years worth of their expenses, coupled with a portfolio that will then incorporate other assets like stocks, maybe high dividend paying stocks, maybe bonds, and some other assets that hopefully add some negative correlation. But I think the cash component is paramount for someone that is into utilizing that income for living expenses. So obviously their propensity to experience downturns and their ability to do that is much more limited. And we certainly take that, we're well aware of that. And I think that's a way to protect that.
Sure. All right. Well, those are all great comments. 2 to 3 years of cash and being invested in the market still with maybe a mix of stocks and bonds. So you've got more elements of safety. So it sounds like you're 2/3 bond in cash, maybe 1/3 the market at this stage of the cycle. The market's really seriously valued, but the market wants to keep marching on and the bulls are still here. So as long as our economy is good, I think the market will probably do maybe 7 to 10% this year. If the coronavirus goes away in a month, I think we'll be good. But if the coronavirus comes back, all bets are off. Well, Alex, I appreciate your time today. Thank you for joining us and sharing your insights, and I wish you all the best.